Well, how's it going, everyone? My name is Amos, and welcome to part 3 in a 4-part series. This is the retirement edition. Now, in retirement, the name of the game changes, right? You're not trying to chase cryptocurrency. You're not trying to grow your portfolio as big as possible. Instead, it's all about capital preservation and that high passive income. You want that reliable dividend payout so that you can pay for the stuff you need to pay for in retirement, like your Viagra subscription, your mortgage payments, and even eating out for lunch at Texas Roadhouse or McDonald's, right? You need some money in order to do that. I think the Social Security payments, they're okay, but I don't think it's enough to replace the income that you need to live with dignity in retirement. And hey, this video is still going to be relevant for you if you are still working. Like if you're 35, like I am, or 45, or whatever age you are, because dividends can cover your Amazon Prime account, it can cover your Costco membership fees, and even pay off your utility bills. Now listen, winter's upon us, right? Do you really want to go the entire winter without using the heater? If you want to use that heater, you're going to have to pay off that utility bill. And guess what? Dividends can actually do that. Because let's be honest, who in their right mind wants to sell shares every single month or every single week in order to feel like you're earning income? Because to me, I just feel like that's crazy. The whole idea of selling stocks in your portfolio in order to create a synthetic dividend, dude, that's kind of stupid. And that's where I deviate away from the traditional FIRE movement of selling 4 or 5% of your portfolio year over year. Dude, why not just do dividends? Because you can get a 4 or 4.5% dividend yield without having to sell anything. That makes so much more sense to me. But I digress. So in this video, we're going to be covering 3 different ETF combos that's going to give you the best high yield passive income. And at a minimum, example number 1 is going to spit out a dividend yield that's around 3.5%. Scenario number 2 is going to be around 10%. And scenario 3, you're going to want to stick around because that's when things get a little wild. Okay, so without further ado, let's go ahead and talk about ETF combo number 1. This is going to be my personal favorite. Dude, I'm nowhere near retirement, okay? I still got like maybe 20 years to go. But if I were to retire right now, this is what I would do. I'm not telling anyone else what to do. This is what I would do. And that combination would be number 1, SCHD and VNQ, which is the Vanguard's real estate dividend ETF. And hopefully you don't mind, but I'm going to go ahead and skip talking about SCHD and DIVO because I've made video after video on this channel doing so, but I don't think I've ever covered VNQ. So what exactly is the Vanguard real estate ETF? Instead of buying properties like buying a house and flipping it or renting it out to shady tenants, dude, I feel like in this country, in the US, there's more laws that protect the tenants than there are the home owners. So that's kind of crazy. Now, I'm not trying to take sides, but there's nothing that makes my butthole more sweaty than the idea of squatters taking over your house and refusing to leave. And then the law and regulation, they go on the side and on the team of that tenant instead of helping out the homeowner. As a homeowner, you got to go through court after court appearances to get that person out. And it can take like 12, 18, sometimes even up to like 5 years to get them out of your freaking house. So if you don't want to deal with any of that, there's VNQ. You can own real estate while getting a juicy dividend yield without having to do anything, without having to deal with any potential tenants. And if we jump on over to the holdings tab, who exactly is a part of this VNQ ETF, right? You got Welltower and Prologis rents out warehouses and factories for people that are in the e-commerce and industrial space. You got American Tower Corporation, Cell Phone Tower REIT. You got another data center REIT right here, Simon Property Group. They're basically responsible for all of the bougie and nice malls that are based in the US and so forth and so forth. It's every single REIT that operates in the US. And obviously the ones that are not as cute, not as beautiful, their share of the pie is like 0.5%. The ones that are good with high growth and a delicious future, well, their share of the pie is a little bit higher. And if we jump on over to their dividends tab to take a look at what we're working with, right now the dividend yield is 3.8%. I would deem that as juicy. That's that Parmesan cheese, you know what I'm saying? And the 5-year dividend growth rate, meaning for the past 5 years, on average, their dividend payout grows at a rate of 3.6%. So that basically keeps up with the rate of inflation. So the value of your income payment today won't lose purchasing power tomorrow. So it's keeping up with the rate of inflation. Now, if we take a look at their performance, their total return, check this out. Ticker symbol VNQ. Now, obviously, for the past 1 year, REITs have just been getting smashed, like putting a watermelon right up their booty hole, and that's because of the high interest rate environment. However, the light is at the end of the tunnel. Interest rates are slowly coming back down. That means it's time for the sector rotation to go back into real estate. Now, obviously, that might not happen, but historically, it happens, right? When the interest rates are low, that's when real estate projects and business starts booming. If we zoom out 5 years, 44%. If we zoom out 10 years, 71%. 15 years, then we're talking about 205%. So by investing into VNQ, your money would have 3x. Is there a 20-year timeline? Yes, there is, friends and family. 272%. So you get exposure to the entire real estate market with VNQ. And then, of course, as a refresher's sake, taking a look at SCHD. Obviously, for the past 1 year, pain. A lot of red. Okay, I'm not blind, I see it. It's trash, it's pooty. We do, 15 years, then we're cooking, right? You would have 5x your money with SCHD in the past 15 years. So how would that manifest in a portfolio that's valued at about $1,053,000? Well, it's what you see on your screen right now. I would go with 50-50 into each category just to cover all of your bases. My personal preference, because of the dividend growth rate of SCHD being around 10.4%, I would probably skew heavy with SCHD, going at about like 70% SCHD and 30% VNQ, but that's me. Okay? Because I prefer my dividend payout to grow at a rate that's higher than just 3.6% or the rate of inflation. If you combine the two, 50% into 100%, then the dividend yield is 3.8%. The dividend payout, we're cooking with $40,000. Now, obviously, if you supplement that with your 401k and your Social Security payments, and if you win the lottery scratch-off ticket at the grocery store once a week, obviously your annual income should be around like $61,000, $62,000 for year one in retirement. I don't think that's too bad, especially considering your car is probably paid off. You probably don't have that many overhead costs, right? Your medication's probably covered by Medicare. Your house is probably paid off or very close to being paid off. So I think with $60,000 all in, not too bad. What's really interesting is if we break it down 50-50, in this portfolio, then about 20,000 will come from SCHD and the other 20,000 will come from VNQ. I think that's pretty darn interesting. It's because their dividend yields are very similar, except SCHD's dividend growth rate is a lot higher. But if you don't have a fond memory of the 2008-2009 Great Recession and it left a bad taste in your mouth with anything to do with the financials or real estate space, then I think an alternative to this ETF combo, I think we could swap out VNQ for DIVO, ticker symbol DIVO. And the reason why I say that is if we take a look at their performance for the past 1 year, now SCHD, you're pretty much flat. But with DIVO, we're cooking with 16.4%. So recent bias, DIVO looks pretty good to me, doesn't it? We zoom out 5 years, we're talking about 91%, 10 years, 187%. And I think there's a lot to like about this. And if we jump on over to take a look at the holdings in their portfolio, let's see, what are we working with? The average PE ratio from 31 different companies is a 23.5, which is a lot smaller than the S&P 500's 31. Their biggest holding at 8.6%. Yes, it's in short-term government notes and bills. You can take a look at their holdings right there, like the Federal Reserve Bank of New York, U.S. Treasury notes, U.S. Treasury bills. So this is where they allow their cash to grow at a very modest and conservative way. But the real company holding number one is Apple. I love that. RTX, I love that. American Express. I think there's a lot to like about their top 15, top 20. I think the only one that makes me hesitate and pause is probably Merck, and that's because I don't feel comfortable about the pharmaceutical space. And if we jump on over to the dividends tab, let's see what we're working with. Their dividend yield is 4.46%. Let's just round up and say 4.5%. Pretty good. But if you take a look at their growth rate of the dividend payout, that's horrendous. Negative 4.8%, but I did some digging and it's slightly better than that, but not much better. So I'm going to say it right now, I'm not too happy about the dividend growth rate of DIVO. So even though the current yield is pretty high and juicy, it's not really growing at a rate that makes my nipples perky, right? Since 2021, their dividend growth rate is actually 2.92%. So this one right here, it's kind of misleading, and that's because they bake in, let me see if I can jump on over to their dividend history tab to show you what I'm talking about. Not dividend history, is a dividend growth tab. Yes, and that's because in 2020, the dividend growth rate was negative 39%. So if you bake that in, then it really skews their data into the bad side of the data calculation. But if you remove that anomaly, which was during the pandemic, and you only include 2021 up until 2025, then it's 2.92%. Now, friends and family, I'm not happy with that, okay? However, if they continue to grow their dividend at a rate of 11% like they did in 2024, and in 2025, I believe it's at 10%. Let me fact check myself. Pulling up DIVO right here on stockanalysis.com. By the way, I have a referral link in my description that gives you a discount code that stacks on top of whatever promo they have going on. Jump on over to their dividends tab, 10.3%. So if they continue in the trend of increasing the dividend payout by 10 to 11% year over year, I'm a happy camper. But if we have those events where they slash their dividend payout by like 30, 40, 50%, not too happy, because then that averages out to a 2.92% growth rate of their dividend. But as it stands, not too bad right now. And something that I like about DIVO over SCHD, as a guy that's invested into SCHD, just because you're invested into something doesn't mean you have to love every aspect about that company. Take the emotions out of it and look at stuff objectively, the good and the bad. What is good about DIVO is their dividend payout is monthly. So if you're reinvesting those distributions and dividends, it allows you to compound your money faster. Because if you have to wait every 90 days to get a payout to reinvest back into the portfolio, it takes longer for that compounding effect. Correct? So if we swap out VNQ for DIVO and we still keep it 50% SCHD and 50% into DIVO, then the dividend situation changes. Not dramatically, but I still think it makes a pretty big dent in the income payout. So the average dividend yield would be 4.1%, of which SCHD contributes 3.8% and DIVO is 4.4%. And keeping it consistent with a $1,050,000 portfolio at a dividend yield of 4.1%, then the dividend payout for year one is going to be $43,500. Now, if you stick with VNQ, then the payout is $40,000. Talking about $3,500, the difference is not that big, but it is still noticeably better with DIVO and SCHD as a partnership. Next year, contingent upon their dividend growth rate staying at their historic numbers. For SCHD, that's 10.3%, and for DIVO, that's just shy of 3%. Then it should increase to $46,429. And the cool thing is, if you break that down on a month-to-month basis, then the dividend payout is going to be $3,600. Now I hear you. Some of you watching this video, you're going to be like, dude, that's not enough. And that's why we're about to go bigger. We're about to get stronger, and the yields are going to get higher from this point on. So something weird about me is that I love drinking a glass or a cup of milk every single morning. I don't know what it is, but it's just one of my things, right? Some people out here, you need to have coffee. And for other people, it's pickle juice, okay? But for me, that's a cup of milk. And then back there, that black tumbler, I have green tea. Now, the cool thing about this cup is it says the Old Dog Sweater Club, right? So my wife, dude, she has a big heart for everything and anything in life where the individual or organization is in need. She does not hesitate to donate or help out and just throw money that way. Like right now, we're sponsoring a child in Bolivia, and we've been doing that for almost 10 years. And whenever there's like a GoFundMe page for someone that's going through a catastrophic event, she's the first to throw down money. But one of her favorites to pitch money towards is a dog sanctuary that's catered towards helping abandoned old dogs to live out the last 3 to 9 months of their life. Right? So it's really heartbreaking. And that's why if you take a look at this cup, you'll see like they're obviously senior citizen dogs. I don't know if you can tell by the graphics. And like just to think about how you keep a dog for like 14 to 15 years. And for some of us, we can't really deal with the heartbreak of putting them down. So you just surrender them to a shelter or to a pound, or you just release them at a park. You just take them off the leash and you drive away. I say that because I used to live in Los Angeles next to a park where people used to do that every single weekend night. And you could hear the dogs howling and crying. And like my window was right there and I could see it. And I'd be like, dude, that's so messed up, man. They would like bring their pit bull, chihuahua, poodle, whatever it is, release them and then just drive away. Oftentimes a dog would chase after them and be like, no, don't leave me. Look, I'm not trying to judge them, right? I don't know what their situation is. Maybe they're getting kicked out. Maybe they're going to jail. Maybe they just don't like the pet anymore. Whatever it is, it's sad, right? And for other people, I think old dogs get surrendered because of their health, because of their age, because they're going into a retirement home and they just can't take care of their furry best friend anymore. And that's why sometimes they end up in a dog sanctuary. So, yeah. But regardless, I feel like on a personal level, a dog only knows how to love us, right? That unconditional love. Whenever you come home from work, whether you had a good day or a bad day, dude, they're so excited to just greet you at the door, to love you, to give you everything, right? To your dog, you're their whole world. They love you so much. And I feel like we owe it to them to at least allow them to live out the rest of their life with us, especially when they get into their senior years. That's just how I feel. All that to say, obviously, this is merch based on that dog sanctuary. And I'm going to tell you this right now. The Dividend Compounders with Cheese channel is going to be launching merch sometime next year. Right now, my hands are a little full. Life is a little busy, as a first-time dad, so I cannot do it. I already know my capacity, my bandwidth has been hit. There's no way in the heck I could deal with the logistics and supply chain of shipping out merch right now. But next year, when my baby daughter gets a little older, that's coming soon. Okay, so right now I'm brainstorming. I'm trying to think about what people would like. Would you like a cup, right? A coffee mug? Would you like a sweater? Would you like a t-shirt, sticker? Would you like a man bra? Let me know, okay? Let's move on to scenario number 2. Now, this is going to be higher income, but that's also going to involve slightly more risk. However, I still think it's good stuff. And it's going to be income ETFs that are focused on the S&P 500 and the NASDAQ 100. You can mix and match the 4 of these to however you like. And I say that because it's really hard to say who's the clear winner, and because their performance and track record just look pretty solid across the board. And that's going to be GPIC, which is the Goldman Sachs variety of the NASDAQ 100. It's also going to be the GPIX, which is the Goldman Sachs S&P 500 income ETF. And it's also going to be the NEOS variety of the S&P 500, SPY, and then of course the NEOS NASDAQ 100 income ETF, QQQI. I think they're all pretty spectacular. The only thing that I wouldn't do personally is go with 2 of the same. So like 2 NASDAQ 100 income ETFs and then just throwing away and disregarding the S&P 500. Probably not the wisest move. And same vice versa, right? If you just go with GPIX and SPY, but disregard the NASDAQ 100, it's kind of like, Now, if you want more coverage and a deep dive into those 4 ETFs, I made 2 dedicated videos that go into the S&P 500 income ETFs and the NASDAQ 100 income ETFs. But to save time, I just want to say this. Like, if we take a look at QQQI, their dividend yield is 13.3%. It's pretty darn juicy, right? And the payout, even better, every single month, every single 30 days. What's not so good, friends and family, what does that say right there? Dividend growth is not available. So with these high income ETFs, you're not really going to see dividend growth. And we can do the same by taking a look at the Goldman Sachs variety. Their dividend yield is 9.4%. Dividend growth rate is also not available. But it's almost like, since the starting dividend yield is so freaking high, it almost doesn't matter that it's not growing, because whatever you don't use in the payout for year 1 or month 1, you can put that and reinvest it into like a high yield savings account or buy more shares and so forth. So you can create dividend growth by acquiring more shares, I guess. Because let's say the dividend payout is like, I don't know, $50,000 a year, but you actually only use 41 grand. What are you going to do with the 9 grand? Right? Are you just going to pocket it? Or it would probably behoove of you to buy more shares of whatever you decided to go with, right? The combination that you like, whether it's SPY and GPIC, or if it's QQQI and SPY-E. Whatever the combination, it doesn't really matter. Unless the two ETFs cover the exact same index. That's the only one where I would kind of pause and to think again, to evaluate. And I know there's a lot of you out here that have hairy chests and you're just naturally skeptical. Let's go ahead and take a look at their performance, right? For SPY-E, for the past 1 year, we're talking about 15.1%. That's taken into account the share price appreciation plus the dividends paid out. If we zoom out 3 years, we're talking about 62%. And if we compare that to the Goldman Sachs variety, which is GPIX, then it's pretty much the same. They're neck and neck, right? 62% versus 60%, splitting hairs at that point. And let's do it again with the NASDAQ 100 variety. The Goldman Sachs past 1 year, 24%. Obviously, the performance is going to be a little bit better with the NASDAQ 100 because it skews heavy with the tech stocks, excluding financials. And if we compare that to the NEOS variety, which I believe is QQQI, yes, sir, right there. Now he's going to think I'm a robot. I'm going to have to do a bunch of little... Yep, I am not a robot. So as you can see, even with these high income ETFs, the performance is still pretty good. So how would that manifest and portray itself in a portfolio that's $1,050,000? I got you. Because I want to limit the amount of arguments in the comments section, I went ahead and gave 25% of the pie to each one of those income ETFs. And adding it all up is what you see right there. If we jump on over to the analytics tab, the passive income, the dividend yield for this portfolio is a 10.5%. Now, this is what is just crazy. The annual dividend payout is $111,000. Now, I don't know about you, but to get a six-figure income from a $1 million portfolio sounds pretty decent to me. No, this is not a yield max. No, this is not a round hill, 80 or 90% dividend yield. But with a 10.5% dividend yield, I think this is pretty respectable. And remember, the name of the game in retirement is not to go YOLO. Is not to go crazy, is not to go gambling away your hard-earned money. It's about capital preservation. So yes, we are sacrificing some yield because I know there's income ETFs out there that can give you like a 50 or 80%, but to go with a 10.5% is still pretty darn good. And your portfolio is not going to go deep into the red with NAV erosion. Now, obviously, because there's no dividend growth, of that $111,830 dividend payout, whatever you don't use, it would almost be beneficial to buy more shares. So, case in point, if you end up buying a new Tesla, you end up paying for all of the bills, and at the end of the year, the fiscal year, you end up with $10,000 left over. To buy more shares of SPY-E or QQQI with that, not the worst idea in the world, right? I'm not telling anyone else what to do. Personally, this is what I would do, right? If I had money left over in retirement, I would probably buy more shares or donate some money to the old dog sanctuary, the people that are taking care of the elderly dogs. I don't know, because at the end of the day, it doesn't matter what you believe in. You're not going to take any of your money with you. Okay, once you croak, that money is gone. So you might as well use it for some good while you're still walking around on this earth, right? I'm not trying to preach, but dude, that's the truth reality, right? What's the point of holding on to all of your wealth and all of your money if you're never going to use it to enjoy a vacation, if you're not going to help others, if you're not going to enjoy a fancy dinner or two? Just my take. Now, with that said, I know this is the retirement edition of the best ETF combinations to get that high yield, that passive income that's juicy. However, we're about to pull the lever into the very aggressive category. For ETF combination number 3, I'm going to go ahead and say this is YOLO because you want the most aggressive income possible. And I can't say that I would personally do this myself, but hey, for some people, their risk tolerance is a lot higher than mine. I'm in my mid-30s, but I'm walking around here with a very low risk tolerance. I can't do it. Okay, so this is not a sleep well at night type of combination because it is pretty risky. And it's risky because it's not conventional. And the dividend yields are pretty darn high. We're talking about an income ETF that's based on the Russell 2000, which is an index that doesn't really get that much love and attention because it's not the big cap blue chip companies, but it's still there. I think everybody and your mother-in-law, everybody knows about the S&P 500. The NASDAQ 100, maybe not so much, but the Russell 2000, dude, nobody really knows about. So an income ETF based on the Russell 2000, Bitcoin, and business development companies, also known as BDCs. You put them all together and you get a dividend yield that's so juicy that it would make SCHD jealous. So what am I talking about? The first one, let's go ahead and cover the Russell 2000 one. The fund manager for this one is NEOS, ticker symbol IWMI. And if we jump on over to the dividends tab, the dividend yield is just shy of 14% and the payout is monthly. That's pretty darn high, right? The next one I want to talk about is BizD, which is the BDC ETF, and their dividend yield is 11.7%. Also very high. And if you click on the holdings tab, the average PE for all the BDCs in the portfolio is a 9.8. What's their biggest one? Their biggest allocation is Ares. I love this one, ARK. The next one is Blue Owl. I think they go by the market capitalization of how they categorize who gets the biggest weighting, because you have the big three represented. You have ARK, OBDC, and Main Street. So there's that one. And then, of course, BTCI, which is the NEOS variety and flavor of generating income from Bitcoin. Now, if we take a look at their dividend yield, 28.9%. Dude, that is absolutely ridiculous. And unlike Yield Max and Round Hill, you might be like, well, isn't there NAV erosion? Check this out. No NAV erosion. Now, obviously, if you bought it at around $65, then you'd be like, no, I disagree, there's NAV erosion. But for the most part, I would argue there is share price appreciation while maintaining a very high dividend yield. And if we take a look at their performance in the stock market, first let's pull up BTCI for the past 1 year. We're talking about 51.8% into the green when you take into account the share price appreciation plus the dividends paid out. I don't know about you, but that's pretty darn juicy. If we add their teammate, which is the Russell 2000 Index Income ETF, then theirs is a 10.7%. And then, of course, to finish it out, BizD. And I do want to call this out, that BizD, for the past 1 year, negative 2.2%, because with the interest rates getting cut slowly, I don't think it's going to be aggressive. I think it's going to be a slow journey. As the interest rates come down, historically, BDCs get sold off and they go lower and lower in valuation. And that explains why BizD is negative for the past 1 year. But if we zoom out 3 years, then with BizD, it's 39%. And with the other two, they don't really have that much history as a publicly traded investment. So their timeline only goes back to July 2024 for the Russell 2000 Income ETF. And for BTCI, it only goes back to October 21st, which is my birthday. Kind of interesting. But you put them all together and you get something that's kind of juicy, kind of risky. And I just want to throw this out there once again. I myself probably wouldn't do this combination in retirement because my risk tolerance is pretty darn low. However, I can't deny that the income that this combination generates is quite tempting to try it out myself. It's kind of like showering naked at a public gym, because there's always like that creepy dude with a saggy nutsack that's like 75 years old. He walks around naked just talking to people with his schlong just swinging all around. It makes me want to shower naked there, okay? So what does the combination look like in a portfolio? This is the cost basis, breaking it down 33% across the board. If we jump on over to the analytics tab, with a dividend yield of 17.5%, dude, look at the dividend payout, $187,000 annually. And that's off of a $1 million portfolio. Dude, I don't know about you, but that's pretty darn crazy. Now, I want to say it again. Out of the 3 ETF combinations, obviously it gets higher in risk with the bigger scenario number. With scenario 1, you get a modest like 3.8% dividend yield. That's a sleep well at night ETF combo. The other one was like 11% dividend yield. And I would say that's moderately risky, but still safe. This one right here, dude, you're generating income on Bitcoin. You're generating income on the Russell 2000. That's historically more volatile. And you're generating income from the BDCs that do tend to have highs and lows depending on the market cycle. The point still stands. The data says $187,000 as your payout. Now, I will say this, out of the 3 combinations, if we do go into an economic downturn and the business operations in the US turn south, the valuation of this portfolio could easily go down to $600,000, could easily go down to $400,000, which who knows what's going to happen to the dividend payout, right? Because if the share price appreciation goes non-existent and goes into the red, then I'm gonna go ahead and assume that the dividend payout is gonna follow suit. So if BTCI maintains like a 28 or even like a 25% dividend yield, if their price goes from $55 down to $25, that means their dividend payout is gonna get reduced in half as well, right? That's where my brain is at. So this one, really risky, but I kinda like it. Out of the three, if I had to pick only one to join my portfolio, me personally, I'd go with BTCI. I feel pretty darn bullish about Bitcoin. And if I had to pick a runner-up, I'd go with BizD. I'm not that in love with the Russell 2000. I get it. When you think about micro caps, when you think about the next small up-and-coming company that could join the S&P 500, obviously you could feel really excited and there's a lot of potential in the future and everything, but my personal favorite index is the S&P 500. The tried and true, the blue chip companies like Microsoft, Apple, Google. The Russell 2000, dude, let me show you this. Right now I'm using ticker symbol RB, which is the Pro Shares Russell 2000 ETF. Jump on over to the holdings tab just to show you what we're working with. Most of you have never heard of any of these companies, right? They're the next up-and-coming publicly traded stocks. Actually, I take that back. There are a few on here that I do feel pretty bullish about. That includes Oklo, that includes Rigetti, that includes Kratos. But obviously that's the top of the top, right? But if we scroll on down to like the bottom section, I don't know, like company number 433, have you ever heard of them? Ingevity Corporation? Neither have I. And is there anything else that sticks out to you? Because there's Yelp, there's the Mercury General Corporation. There's a lot of companies that I personally don't know. And if I don't understand their business model and stuff like that, it's hard for me to feel bullish, right? It's just based on speculation and it's based on past performance data to be like, oh, well, Russell 2000 should go here based on the past. But it's like, how do I know, right? With the S&P 500, I'm not trying to be a show off, but I pretty much understand almost every single one of their holdings and their operations. So it's easier for me to be like, oh, okay, well, I feel pretty happy or not so happy about XYZ. But with the Russell 2000, it's like throwing a dart in a bar room that's just too dark. I mean, you might throw it into the bartender's head, right? It's like, it's kind of scary. Well, there is one that I do recognize. Where to go? Big Bear AI. We covered that on the channel. Ticker symbol BABY. There's Wolverine Worldwide. This is the parent company of a bunch of shoes that you and I used to wear, like Sperry's, Merrell, which is pound for pound one of the best hiking shoes, Saucony, which are one of my more favorite running shoe brands. I can't believe they're in the Russell 2000. I felt like Wolverine should be in the S&P 500. But anyways, I digress. I want to ask you, how do you feel about the three ETF combinations that we covered here today, especially for the high yield passive income retirement folks in mind? Do you like it? Do you hate it? Do you own some of them? Let me know. Next time in part 4, we'll cover the best ETF combinations that do not pay dividends. I know, even just saying that, it almost makes me sick. Like that jerk off that takes his dog to take a dump in your yard every single evening and never picks it up. But luckily you have an Amazon Ring, you have a spy camera and you've been recording him and he still refuses to pick it up. It just makes me sick. But you know what? Even if something doesn't pay a dividend, I feel like eventually with due time, most people that invest into just growth stuff, they eventually join the dark side and they become a dividend investor. I think once you get burned a handful of times, you're like, okay, I want to stop with the speculation. I want to stop with the narratives, and I want to go with something that has solid, stable fundamentals and good financials because they're able to pay and finance that dividend because their books look good. Due time, most of us become dividend investors. But with that said, I get it. Not everyone likes to deal with dividends and the associated taxes. So for the next video, I got you guys. And before I get out of here, I just want to say, I genuinely hope you have a good day and a good rest of your week, in case no one else has said that to you, okay? I love you guys, stay safe, good luck in the stock market, and I will talk to you next time. Peace.